Moving past valuation, let's get into the ownership aspect of stocks. So if a company wants to become publicly traded, they will go through an initial public offering. The company will go to an underwriter, and the underwriter will go through their financial books and look at different aspects of the corporation to make sure that it's an organization that they can support writing shares for and offering as an investment to their clients. And if they decide to move forward, they'll go ahead and underwrite the shares and work with Wall Street investment banks to offer the initial shares to the public. The first day that they do that is referred to as the company's initial public offering, or IPO, and oftentimes larger IPOs will have the company executives at the stock exchange ringing the bell. So ultimately what the IPO does is raise money for the company, which allows the company to invest and grow more quickly. As a retail investor, to be able to invest in a company is great, but what I'm implying here with this circle is that not only should you invest in the companies that you want, but hopefully they're companies where you already are making purchases from them. Now, as a retail investor, you don't always have the opportunity to purchase the products from your investments, but you should believe in the companies you are investing in. And typically when a company is going through an IPO, it's because a lot of people believe that it has a bright future. All right, let's get into dividends. Dividends come out of your net income. Essentially, when you have a positive net income, you can go about it two ways. You can issue a dividend, or you can hold on to the cash and use it for reinvestment. In this particular example, on the previous slide, I showed a locomotive to imply that the company is a railroad. So for them, the investment could be new locomotives. Say they make that investment, then choose to issue the remainder of their net income as a dividend to their shareholders. This helps them provide a stable return to their investors and will attract more shareholders over time. So typically, when you issue a dividend, that's indicative of a more stable operation where you can guarantee your investors a reliable return like that. So in general, these are companies that have existed for longer periods of time and have very stable income streams. That's why some investors are so focused on dividend-only stocks. They believe that they're taking on less risk by focusing on only those companies. Now, the criticism is that they miss out on price growth and sometimes lag behind the market. But the reality is that there are over 1,000 dividend-paying stocks traded in the United States, and they produce a variety of outcomes, some of which do have very good price growth. So when a company issues a dividend, you just divide the dividend by the total number of shares to come up with the dividends per share. Then depending on the number of shares that you own, that will tell you the amount of income that you get. When working with dividends, the thing that you want to keep in mind is dividend yield, which is just dividends per share divided by the share price. So another way to think about that is for every $100 that you're investing, how many dollars are you getting back in return? So dividend yield is something to definitely pay attention to when comparing different dividend stocks. A higher dividend yield is generally going to produce a better return for you, but that also comes with more risk associated with producing that return on a regular basis. So make sure that you're paying attention to what the company needs to do to arrive at their net income result to produce those promised dividends. Sometimes they're doing that through synergies from mergers, sometimes it's through cost cutting, but I'm of the opinion that you need to pay attention because if they're doing it by not investing in the right areas or intentionally as a way to return money to large shareholders, it could distract from the mission and harm the company. So while dividend-paying stocks tend to be more well-established companies, you still need to do your research and make sure that the company you're investing in is investing in itself and its future. As it relates to buybacks, this is when an organization wants to reduce the number of shares that they have outstanding. Now, in order to do that, you need to offer the investors that own your stock a premium. Just for example, say shares are trading at $24, then you offer the shareholders $25 a share in order to engage in the buyback and to remove those shares from the market. So you're offering a 4.2% premium, and a lot of short-term investors will take that. The shares bought back are then removed from circulation, and the end result is that instead of having 100 million shares outstanding, you now have 90, The value of your cash flows do take a little bit of a hit with the $250 million of cash that is required to engage in the buyback, but your total $2.4 billion valuation won't lose all of that. So say now all of your cash flows are worth $2.2 billion. Well, at that value, your share price is now going to be $24.44. And so just like that, you've increased the share price of your corporation. And a lot of corporations over the last 10 to 15 years that had cash available to do that and did have been accused of using buybacks as a way to hold up their share price. Now, there's a certain amount of truth to that, but there's also a variety of reasons why corporations may engage in buybacks that have nothing to do with their share price. It could even have to do with other corporations or large investors trying to take over them, and the corporation trying to better position themselves and their current shareholders. So while there are a variety of reasons why an organization might engage in a buyback, it's not just stock price growth. Certainly there can be some good short-term gains, but you also need to understand that those gains are generally immediate, like as in the moment the buyback is announced. So if you hold on to the stock to try to capture any post-buyback returns, by the time the buyback goes through, sometimes the remaining return, for possibly sometimes unrelated reasons, those have been erased and you might actually be looking at a loss at that time. So with anything related to investments, just keep in mind the market and organizations can change at any time, and you have to do what's right for you and what you think is best. So if you're presented with an option to have some of your shares repurchased and you want to take it, then do it and find something else to reinvest your gains in. And if not, you still get to keep the stock and you maintained your position and you're able to continue to gain value there. From the same respect as buybacks, corporations will engage in stock splits. Splits are not another public offering. They're not issuing more shares through an offering. They're creating more shares through a split, and the new shares go to the current shareholders. A lot of times companies will engage in these types of activities when they feel that their share price has grown to an unsustainable level or a level that prevents more mainstream investors from owning their stock. In this particular example, using the same stock, say they announced a 2-for-1 split. The important thing to understand here is that with a split, the cash flow valuation of the corporation doesn't change. Both before and after, it's the same $2.4 billion. So if the organization engages in a 2-for-1 split, their share price simply goes from $24 a share to $12 a share. Now, you as an investor, say you own 10 shares. So you own $240 worth of stock. Well, after this transaction is done, you still own $240 worth of stock. You just own 20 shares instead of 10. So it doesn't really change the valuation at all. It just opens up the stock to more investors by making the share price more attractive. Now, in terms of shareholders' rights and things to be aware of, corporations do have annual meetings. Annual meetings, at least most parts of them, are open to shareholders. Essentially, these events are gatherings of all of the largest investors and the company's senior managers so that they can meet and share results. Typically, this is where they share their annual report and discuss their performance and investments in greater detail. The corporation can also hold votes, although a lot of that is done digitally now, and they'll also discuss their strategies for the future and the metrics that they're going to go after that will allow them to achieve their goals. There's also quarterly earnings calls where they discuss similar subjects and performance towards goals and their progression throughout the year. On these calls, you'll hear investors from Wall Street ask them questions. You can listen in on these calls and hear what they're saying. Generally, most of the questions will pertain to their cash flow valuations, the market outlook, the corporation's outlook, or even discussions on future investments, or how investments that they talked about on previous calls are performing today. And if you're investing in corporations, I'd encourage you to listen to these quarterly earnings calls because you'll be left with fewer surprises and you'll have a clear understanding of what's going on with your investments. As a shareholder, you have voting rights that control the board. You can vote for the board members, and the board members set the strategy and control who runs the corporation. So as retail investors, you still have a voice through those voting rights. Now, if you go to an organization like a mutual fund or a hedge fund, essentially what they're doing is you're investing in their fund, and then they're using your money to purchase stock, and that gives them the voting rights, meaning that they are using your money to have control over these corporations. So this is something that's very important with stock ownership that you need to realize and understand. By purchasing the stock yourself, you now have the control. Yes, as a retail investor, you may not have that many shares, and that's true. But as we've seen with examples like GameStop, when retail investors work together, they can push for outcomes using their collective power. It kind of works like democracy. So if you're able to work towards a common goal, collectively you can exert an immense amount of control over that board. And they're who's running the corporation and setting its overall strategy. So exactly what do you vote on? Well, you vote on, who are the board members. You can also vote for or against mergers, as well as different major actions that the corporation wants to take. Historically, you always voted by mail or at some of the annual events. But with new technology, a lot of the voting is done digitally. You receive basically an email notification and you fill out what looks like a survey, and that's really all it takes to cast your vote. It's important to note, though, that you can also designate a proxy. So this is just sort of a representative for owners who don't want to vote, who trust the proxy's vote, or who don't know enough. So they'll select someone else to vote on their behalf. Now, once the delegation is made, the proxy can then further delegate to others, or if they'd like, they can then cast the votes however they see fit. Now, if you want to feel like you have a voice in your investments, I'd encourage you to read their annual reports, to attend the calls, and to use your vote so that you can engage with your investments and make them aware of your desires. Now, the corporation will make recommendations to you on which ways they would like you to vote, but you don't have to follow their guidance. You can go your own way. Just know that they're typically going to make recommendations that from their perspective are in the best interest of the company. So generally you want to listen to them. They know their business better than anyone, but certainly if they're trying to recommend someone or something you don't agree with, you can use your vote as a voice of opposition. So who are the shareholders? You may decide that you want to invest in a particular stock, but how do you know who already owns that stock? Well, there's a variety of ways that you can go about doing that. The SEC has their website. You can go and investigate the stock there. They'll have all of the information that's publicly available to you, and you can even download copies of all of the company's filings. There's also other websites out there like Yahoo Finance that do a good job. And here are some screenshots from Yahoo where you can see how ownership breaks down both from an institutional perspective and with mutual fund holders. In addition to that, you should be aware that you can see the inside roster and their trades, meaning you can see the holdings and trades of the executives of the corporation. You can even see their transactions because they're required to report them. That way it's clear how the executive owners of the company are handling their stock. So if you want to know what the CEO is doing with their shares, that's public information and readily available. If you want to access that information, you can do so either through the SEC's website or through these other financial sites.